as regional economist in 2006 and was promoted into his current role in 2009. Prior to joining the bank, he worked as a senior economist for Moody's and then also as an analyst for the Congressional Budget Office. He's also spent time as a faculty member at Kent State, where he taught macroeconomics, money banking, and economic history. He's also a board member for the North Carolina Council for Economic Education and the Belk School of Business Advisory at University of North Carolina, Charlotte, right here in our town. And he recently served as a member of the Charlotte-Mecklenburg Opportunity Task Force. Matt has a bachelor's degree in economics from the United States Military Academy at West Point and a doctorate in economics from the University of Delaware, which he earned after completing his military service. So I guess it's safe to say that Matt has done a few things in his career, both in the public and the private sector, as well as serving in our military. And on behalf of our team here, Matt, thanks very much for your service to our great country. We appreciate it more than you know. Obviously, that's hit home with a lot of us this week again as well. But please join me in welcoming Matt Martin. Matt, thanks so much for being with us today.
Thanks, Pete. Appreciate that introduction. And yes, please keep those in harm's way in this current environment, and your thoughts and prayers. Definitely something weighs on my mind. As Pete indicated, so I am with the Richmond Fed, seated in Charlotte, and so my vantage points are, my main role is really to help us understand what's happening on the ground in the Carolinas as an input to monetary policy. So, I see what our bank's president is thinking about and the conversations he's engaged with his fellow members of the Federal Open Market Committee that decide monetary policy. And then I'm helping to ferret out answers to some of those questions throughout North Carolina and South Carolina. So I'm going to give you an overview, mostly at the national level, because that's where most is happening. But I have a couple of slides just to give you an update on what's happening in North Carolina as well. So can you see my full screen? Okay. This is just, and I'll make these slides available afterwards. This just says these are my own views. In case I say anything really stupid, they can disavow me. So a quick summary screen here, and I think these were probably sent out ahead of time. Here's where we are now. The economy, after being shut down for a few months during COVID, has rebounded pretty strongly. And particularly this year, we have 2 quarters of GDP growth that looks strong, and I'll show you that in a second. And we're expecting above trend growth to persist into next year. So where we are right now is GDP is actually finally above where it was in the first quarter of last year when COVID hit. We shut the economy down. We would have had some growth there, so we still have room to make up. But overall economic activity has recovered pretty nicely. And it's done so, though, without a full recovery in the labor market. And so hiring has trailed, but that's shown signs of real strength in the last couple of months. So we're starting to make up some ground there. And then, of course, this has happened with a lot of fiscal and monetary support. And it looks like we're going to get some additional fiscal stimulus of one form or another here before the year is out. Regionally, North Carolina, as has been the case for some time, is faring generally better than the U.S. as a whole. But we're in this region in the South where cases are up, and this Delta variant is a bit of a risk. It does not look like the impacts from Delta will be anything like what we saw last year. For one thing, even though vaccine rates lag in the Carolinas compared to the U.S., we've still got over half the adult population vaccinated, and that's a bulwark. And I'm not sure there's an appetite for substantial shutdowns at this point either. So we're going to talk through all this, and I'm going to go through some of these fairly quickly. But again, I'll send these out to you. So starting with GDP here, this is quarter to quarter changes, which get reported at an annual rate. So that's why the second quarter decline is over 30%, and the third quarter increase is also over 30%. Those are annual rates as if those changes had occurred over a full year. So those figures look alarming. Where we are now, as you look to the right of the the first strong rebound quarter from last year. The last two quarters of the first quarter this year and the second quarter, both over 6% growth at an annual rate. And that's quite strong. And you see a projection, a forecast in there from members of the Monetary Policy Committee, about 6% growth for the year. And these are quarter four compared to a year earlier is what the forecasts are. So they're expecting strong growth this year, somewhat more moderate next year, but well above trend, 4% and change. And then in 23 and beyond, sort of going toward trend growth. So that's a pretty strong growth projection and sort of gets us back on track where we would have been if COVID had not happened. So that's, I think, important. But we only have the read through June. Quickly, if you want to see what's happening on a monthly cadence, we do have surveys of business activity. This shows two for manufacturing, the Institute for Supply Management. The national level is in blue, and then the Richmond Fed for our territory, Maryland and West Virginia down through South Carolina, is in red. The line across horizontally is sort of the break even. Anything above that signifies expansion. And these readings for manufacturing are quite strong, have been since last year, the second half of last year. Similarly, this is the same two surveys for the services side, maybe not as quite obviously as strong, but these are still strong readings, well above the break evens on these surveys, suggesting a pretty broad-based increase in economic activity month to month. And then the question comes, what's driving it? Well, it really starts with the consumer. And I could show you a lot of data on consumer income and spending. What's interesting is we would normally show this as year-over-year changes, but the numbers are so wild that I'm going to show you something different here. This is the personal savings rate. So how much is saved out of current income as a percent? And you can see that we were pretty flat around 7-8% for most of this previous expansion. And then you see these spikes upward that correspond to the various stimulus payments that have been sent to households. And we haven't seen savings rates come back down, right? So where they are in June is still a little bit elevated. The estimates are consumers have about $2.5 trillion in excess savings. I think some of that got spun out into the economy this summer. I think throughout COVID, spending on goods, so groceries, home gym equipment, bicycles, whatever, cars, whatever you could spend money on the good side, consumers did a lot of that and weren't spending on services, particularly travel. I think we know we had a good season travel wise. My family, we were out in Wyoming and at Yellowstone. I can tell you the national parks were just absolutely jammed this summer. So people aren't going to Europe necessarily, but they were all over the US on vacation. So a lot of pickup there. And really that's what's driven it, is the consumer has been quite strong, supported by a lot of fiscal policy. Now, what's interesting, consumers have money to spend. In some cases, they can't spend it, particularly on the good side. So this shows you auto sales. And I'll just look at that top line number. July was a pretty weak number, under a 15 million annualized rate when we'd been running over 16, closer to 17. It's an inventory issue. You've probably all heard about the lack of chips for cars. That has also spilled over. Think of appliances, anything that requires a computer chip panel in it is having a hard time getting product out the door. So that's limited sales to some extent, and maybe it pushes it off till later in the year or even next year. We hear the chip shortage. Most companies are expecting that'll last into next year, because and I'll get to this in a second, you hear about firms trying to maximize production lines. You don't hear near as much about firms saying, we're going to build a whole new factory. And the reason is, and I hear this all the time when I talk to companies, we're not sure how much of this demand is long-term sustainable demand. So we're going to wait until we have a better idea. Okay. So it's showing up in things like cars. And then I'll note in new home sales as well. And we just this morning got the July figures. There were some revisions in there, so I don't think it drastically changes the picture here. But you can see it really was hard for us to ramp up home building this last cycle. It spiked in the midst of COVID, low interest rates. Everybody's at home, and they're realizing by working at home that they don't like their house and they want a different house. People choosing to work remotely, particularly office type workers. But that's petered out with all those home sales last year. And what we hear from home builders is we're out of lots. We don't have buildable lots, and we're having high construction costs, and labor's hard to find. Subcontractors are really difficult. So there's lots of headwinds here, and that's slowing it down. So again, I think there's lots of reason to think home demand should be somewhat strong, but some of this is going to get pushed off because of these constraints. Interestingly, though, commercial construction has found a way to plow through all of this. And so what this shows you is a census survey on what's called construction put in place. Every month they survey a bunch of firms, and it's an estimate of the dollar value of construction actually conducted in that month. And you can see the dark blue line, residential has trailed off since late last year or early this year. But commercial, all types of commercial has picked up. But this includes things like oil and gas and some other things that probably aren't relevant to this crowd. But I think it also includes a lot of classes that are up, from folks like engaged in your business. I hear about warehousing, industrial space in particular, maybe some other forms that are really cruising along. So all of that has happened, and consumers are helping push a lot of this activity, despite the fact that we're well below where we were employment-wise. And I won't dwell on this. I'm going to go through some slides here pretty quickly. Again, we would normally show you year-over-year change in payroll employment, but the wiggles are so big, I'm showing you the level. Last April, we dropped from what had been years of very steady growth back to where we were at the bottom of the Great Recession. An initial surge back that was strong, and then we had some months where there wasn't much employment growth. And the last couple of months, that's really strengthened again. But we're still almost 6 million jobs short of where we were. And if you look at the unemployment rate, that means it's a bit elevated, but probably not as high as you would think if we were 6 million short of where we should be. I'll just note here again, as before, you have a forecast for the unemployment rate, suggesting by the end of next year, we're going to be back roughly where we were before COVID hit. What makes up the difference? We're not as many workers as we had pre-COVID, but an unemployment rate that's starting to look healthy is a lot of people haven't come back into the labor force. And so I will dwell on this for 1 minute. This is the labor force participation rate. So the percentage of adults who are either working or looking for work, meaning they're engaged in the labor force. And you can see some long-term trends, because this data I'm showing you post-World War II data. If you focus post-Great Recession, there was a decline and then a leveling off. And then when COVID hit, a substantial drop. A bunch of people stopped working, stopped looking for work. We've got about half of that back, but now we're sort of stuck at about 61.7% when we had been above 63. So that's 3 million plus workers that have left the labor force and not come back. And it's a question of whether, are they going to come back? And I think the answer is possibly some, and likely some of them will, but not all of them. To give you one data point, last year we had 3 times the normal retirements of a given year, and mostly older workers. And I think they were helping keep labor force participation elevated at the latter end of the teens, 18, 19. But it's a lot of folks in their 60s, and they're not coming back. And I think we're in the midst of a sort of a repositioning for a lot of workers. I hear stories coming out of, say, the restaurant industry or hospitality. Hey, I worked in that industry for a long time. COVID, I went and I had to because my restaurant or hotel wasn't available. I figured out some other work, and I realized how miserable that work was. I don't want to do it going forward. So I'm permanently going to look for something else, or families who've restructured, who's working and who's staying at home, kids not in school. That's part of it. And one I think that is still out there is office workers who decided to work remotely from someplace else and have actually moved. The return to office keeps getting pushed off for a lot of companies. And I think, we're going to get to the point where some say, yeah, you got to be back in the office at least a couple days a week. And someone who's moved away says, nah, I'm not going to do that. I like where I am. So there's a lot of churn in the labor market from this. And it's delayed some rehiring, I think. So North Carolina, let me give you a little bit of the lay of the land here, and I'll go through this quickly. You can digest these on your own. Forgive the districts here. I borrowed this from a colleague who was talking about education, so that's why that's in there. But basically, the darker the blue, the more that county has recovered to pre-COVID levels of employment. So there are a couple of patterns here. First of all, the larger metro areas, Charlotte, Raleigh, Durham, Winston-Salem, they're all in this 95, 97% range, not quite back the whole way, but mostly back as far as employment. You've got some lower populated rural counties that are the really second shade to light blue and the like, so they're not recovered. And then you got some coastal and a couple of mountain counties that are more than fully recovered, and that includes Wilmington, for example, where they've come back with a real bang. And then it's kind of mixed beyond that. So I don't know that there's an overarching pattern here, but I think it's interesting just to see who's done better than others in sort of recovering jobs. And some of the variation is related to what's happening by industry. And so this shows you the change in employment from February of 20, which would have been the previous peak, to the latest data we have in June. Not surprising, and this is in thousands of jobs, not surprising, the biggest chunk of job loss still is in leisure and hospitality, with education and health services. And that's, school and public school teachers and the like, they're actually government employees, so that's not what we're talking about here. It's other education and health services, which includes, hospitals are down, assisted living centers, employment way down, and some others like that. The one that's interesting to me here is manufacturing is still down a bit, and part of that's the mix of manufacturing, but part of it is manufacturers are going to have openings that they can't fill. A lot of them were jobs that were $12 to $14 an hour. They're pretty much all 15 and above. So wages have moved. They're trying to attract more employees. In the meantime, they're putting out as much product as they can. And so productivity has almost certainly gone up in manufacturing as a result. And the other thing I'd note here is trade, transportation, and utilities is actually well above pre-COVID levels. You all are probably hearing about, with the supply chain issues, are issues like delays at ports, trucking delays, things like that, which I think has some interesting implications for commercial real estate that I'm sure you've heard about. Companies don't want to be overly reliant on overseas inputs, particularly from one country. So if China's a real holdup, they might try to diversify away. And they're probably going to have more inventory on hand going forward. So in case there are hiccups in the supply chain, they've got something to fall back on. One last viewpoint, and I'll explain this. So across the horizontal axis is just the year-over-year change in employment, but the vertical axis is the average annual change over a 10-year period. So the higher the circle, the better that metro area is done over the last decade. And Raleigh's the winner there, with Charlotte in second place and Wilmington in third. To the right, it just shows you the further to the right, the more they've had job growth over the last year. again, Raleigh's among the winners there. I note a place like Asheville was hit really hard because of leisure and hospitality. Their year-over-year change is about 8%, but they're still well below where they were pre-COVID. And you can see where the laggards are. It's basically our post towns and Rocky Mount are the ones that are struggling the most over time, and probably even here more recently. All right, Fed economists, the other half of our mandate is inflation. I won't spend a lot of time on this, but it affects things you might be interested in, including interest rates. Inflation is quite high right now. We did get the CPI data for July. Doesn't change the picture a whole lot. This is the Fed's preferred measure, for which we have a target of 2% growth over the medium term. And again, you can see a forecast here, importantly, for this measure that shows by the end of next year, the expectation is we'll be much closer to our target. And the term you'll hear from Chair Powell and others in the Fed is they expect a lot of inflation to be transitory. And I do as well, but this is, we're in a higher risk environment for inflation than we have been in some time. So this is one that bears watching. But you can imagine as we get into the second half of this year and into next year, as some of these supply chain issues get worked through, that commodity and other prices start to fall. It's already happened with lumber. Lumber shot way up, and now it's back to something that you could call sort of a normal price, right? So I think that'll happen with other inputs, which takes the pressure off of raising prices for final products as well. The good news is we can read from bond markets both sort of near-term and long-term inflation expectations by market participants, and that's what this does. The red line is a backed-out measure of inflation expectations over the next 5 years, and that's moved up quite a bit. But the longer-term inflation expectations, which is the blue line, it's moved up, but it's in a range that we've seen in recent history. So it's not broken out of any sort of range for longer term inflation expectations. And so far, that's a good sign. And then here's your forecast for the Fed interest policy rate. I'll just note, nobody's expecting any rate increases this year. You have a still minority of members expecting 1 or 2 rate increases next year. And then a majority by the end of 2023. So monetary policy, as of the June meeting, forecasted not to change for a couple of years. And with that, I will stop and take questions if there's still a little time.
Anybody have any questions for Matt? That was really great information, Matt.
Awesome stuff.
Yeah, sorry about the speed.
Well, we kind of put you on a tight time frame too.
No, that's great. Matt, what about the North and South Carolina region? Just your general take. We're obviously continuing to see a great population influx into our great state, and that seems to have been supercharged through the pandemic. What are your thoughts on that going forward next 2, 3, 5 years?
Yeah, I don't see anything that upsets the apple cart as far as growth. My thoughts tend to quickly turn though to the regional dispersion of that growth. So the big metro areas, Charlotte and the Triangle in particular, have continued to get most of that growth, but there are opportunities for the smaller areas with remote work and some other things, and just generally this idea of people sort of restructuring their lives to be where they want to be. There's some prerequisites there. An area has to have broadband connectivity, but I think the secondary winners here are Asheville and Wilmington and places like that people want to be. The challenge, I think, for those areas is particularly Asheville is like housing affordability and trying to get in, say, young working adults who would be happy to be there, but are still kind of early-ish career. The jobs are there, and they got to find a way to make it work to live there. So that, we were just in Asheville last week, and it was striking that the housing issues that they need to wrestle with there. So as long as a region like that can figure out how to make progress on some of those issues, I think a lot more areas than just Charlotte and Raleigh can benefit from the influx in North Carolina. And same in South Carolina. Charleston's got similar issues with the constraints of geography being by the ocean. And the upstate, I think, is the other place that's clear winner there.
Thanks. Other questions for Matt? Going once? Well, Matt, thanks so much for being here with us today. We appreciate it more than you know. Like Teresa said, great and encouraging information for all of us and for our region. And as I think you indicated several times, we'll make sure to share the recording and the slides with everybody. And thank everybody for being here. Teresa, anything else?
Nope, I think we're great. Thank you so much, Matt, and everybody for attending.
My pleasure. Thanks for the opportunity.
All right.
Thanks, Matt.
Thank you.
Bye-bye.
All right, thanks.